This is a very good question on IAS 16, Property, Plant and Equipment. It is from the Diploma in IFRS exam, December 2013. As you can see, it is question 4. And as always, we will begin with the requirements. It says, compute the carrying amount of the factory in the statement of financial position of Omega at 30th September 2013. You should explain your treatment of all amounts referred to in this part in your answer. Very straightforward requirements. There are two things. One is computation. Second is explanation. In the exam, a number of the candidates did not explain the treatment of all the amounts referred here, and of course they lost marks for that. We have got 14 marks for this question, so it is possible that nearly half would be for the computation and nearly half would be for the explanation. So let's prepare our answer. Before I actually begin to answer this question, I would like to review some of the key concepts of this question, because basically the purpose of this video is to review. Let's give a title to this page: Review of Concepts. IAS 16. It is about property, plant and equipment, it is a very important standard both in real life and as well as for the exam. In this part of the question, we are asked to calculate the carrying value or carrying amount, which equals to cost less depreciation. Now for cost, we need to include the purchase cost, purchase price, or if we are building it, then the construction cost. Then we need to take care of directly attributable costs, and we also need to take into consideration restoration costs. Restoration is that you have an asset now, so this is your year 0. You are planning to use this asset, say, for 10 years. It is the end of its economic life. At the end of its economic life, if you have any obligation to clean the place or to restore it to its original condition, or to bring some changes into it, and this obligation is either a legal obligation or you have made a promise, and for your promise you are obliged to do that. This cost will incur here, so there will be an estimate for this time. And as there is 10 years time between the time when we will be spending the money for restoring the asset, and as there is a time like 10 years for this cost to incur, and we need to include it into our cost of asset now, we need to discount it to present value. When each year passes, like the year of end of year 1, then year 2, year 3, year 4, because we have discounted it, we need to unwind it. This unwinding will go as a cost, as a finance cost, to the statement of profit or loss, and it will go to the statement of financial position as a liability, as a provision. The present value will also be part of this provision, and the unwinding cost will also become part of this provision. So this provision will grow over the 10 years, and at the end of these 10 years it will become again our equal to our initially estimated cost. The requirement is carrying value. For carrying value, the present value as a restoration, that is important. We need to include this into our answer. We also need to have the depreciation, but these parts are not relevant to our answer. Ignore. With this overview, let's begin answering the question. Question 4. Omega. Part A. We will have two important parts. One is computation, another is explanation. Carrying value is a fairly mechanical topic, so instead of reading the whole question, I would put the figures into its relevant places as we come across them. Omega is a listed company which prepares financial statements in accordance with International Financial Reporting Standards, IFRS. With some explanation. On October 1st, 2012, Omega purchased some land for 10 million, including legal costs of 1 million. Now this is a directly attributable cost, so this would be capitalized, so we don't need to deduct it. If we write 9 million, this would be wrong, in order to construct a new factory. So let's put it there. Cost of land. Let's have all our figures in thousands. I will write here it is 10,000. Explanation. It is a direct cost including the legal cost. Construction work commenced on 1st November 2012, so this is 1 month later. Omega incurred the following costs in connection with its construction, preparation and leveling of the land, and leveling, it is 300,000. Explanation, it is a direct cost. Purchase of material for construction, 6.08 million in total. Direct cost, we need to include it. Employment costs of the construction worker, 200,000 per month. We have 11 months. It is from November to September 30th, 11 months. So 200 would be into 11. And overhead costs incurred directly on the construction of factory, 100,000 per month. Let's include all these three costs. Material, was 6.08 million. It is a direct cost. We have workers' cost, a direct cost for 11 months. 200 into 11 would be 2 million. 200. And then we have overhead, which is directly attributable. It is also a direct cost. For 11 months. Ongoing overhead costs allocated to the construction project using Omega's normal overhead allocation model. This is not a directly attributable cost. Overhead allocated nil. It is not a direct cost. Income received during the temporary use of the factory premises as a car park during the construction period. Income when building an asset can be of two types: incidental, and let's call it for our purpose non-incidental. Standard has quite a long explanation for it, which says proceeds from selling any items produced when bringing the asset to its location and condition. This income for car parking is not the non-incidental, it is the incidental, this one. So therefore it cannot be deducted from the cost of this asset. Parking income, no, it is incidental income, and it would be directly recognized in the statement of profit or loss. Costs of relocating employees to work at the new factory. Relocation costs are not directly attributable to the asset. So we have relocation cost, nil. It is not a direct cost. Costs of the opening ceremony on 31st July. opening ceremony. No, it is not a direct cost. Good. The factory was completed on 31st May 2013 and production began on 1st August 2013. Okay. So the factory was completed on 31st May 2013. So two of our costs, which are the employee costs and the overhead costs which we included, should not be counted until September the 30th, but it should be counted up to 31st May, which is starting from 1st November when the construction started. It is 7 months, not 11 months. So we need to adjust our answer. It is for 7 months. This is also for 7 months. 700, and this would be 1400. The overall useful life of the factory building was estimated at 40 years from the date of completion. However, it is estimated that the roof will need to be replaced 20 years after the date of completion, and that the cost of replacing the roof at current price would be 30% of the total cost of the building. This is an example of a complex asset. In a complex asset, we have to depreciate each component separately. In this example, the overall depreciation would be over 40 years, but for the roof it will be over 20 years, so the economic life is different. Let's put it in the right place in our answer. Let's give it a few lines. Depreciation. For depreciation, we will need the depreciable amount. Overall depreciation. This depreciation would be the depreciable amount divided over 40 years into 70% and then into 4/12, because the factory is finished in May, June, July, August, September, 4 months depreciation. And then there will be roof depreciation. Divided by 20 into 30%, 4/12. At the end of 40-year period, Omega has legally enforceable obligation. So it is an obligation to demolish the factory and restore the site to its original condition. The directors estimate that the cost in 40 years' time, based on prices prevailing at that time, will be 20 million. So we are given the cost at the end of 40 years. Now we need to discount it to the present value. An annual risk adjusted discount rate which is appropriate to this project is 8%. The present value of $1 payable in 40 years time at an annual discount rate of 8% is 4.6 cents. So the examiner has made our job easy. He has given us the discounted value over 40 years. Let's include it into the cost. Restoration cost, present value, it is 20 million into 0.046 because it is 4.6 cents. It gives us 920,000. The construction of the factory was partly financed by a loan of 17.5 million taken out on 1st October 2012. The loan was at an annual rate of 6% during the period 1st October 2012 to 28th February 2013, when the loan proceeds had been fully utilized to finance the construction. Omega received investment income of 100,000 on the temporary investments of the proceeds. In this paragraph, the borrowing costs for construction of an asset are examined. Let's review them and then we will go to answer it in the question. Borrowing costs. These borrowing costs are for building non-current assets. In the revised IAS 16, they are allowed to be capitalized. So previously it was different. So it is a revised treatment. Borrowing costs would be either directly attributable in this case, just capitalize them, or they will be taken out from a range of loans. In that case, we need to first find the weighted average cost and then capitalize them. In addition, the standard says the finance cost equals borrowing costs less any income which has been earned from investing the loan for this asset. In our example, the loan was taken on 1st October, but until February 28, this was not used, or maybe it was not used fully, and this money was invested into some kind of financial instrument and there was income from it which was 100,000. Another point which is important for borrowing costs is only during the construction period. In our example, the construction was finished on May 31st. The answer does not tell us when the loan was paid back, but that is not important because the borrowing cost until May 31st can be capitalized, and the rest of the borrowing cost that will go directly as a finance cost into the statement of profit or loss. So let's have our finance cost. We will explain it a little here. Borrowing cost less income. Our borrowing cost is into 6% into how many months are from October to May? It is 8 months. 8 over 12 minus less 100. 1000. 700 less 100. Our finance cost is 600. We don't have any more points in the question, so we just need to finalize our calculations and our answer is there. The total cost of asset is 20 million. The depreciable amount is 20 million less than 10 million because 10 million is the cost of land and land is not depreciable. We will have it as 10,000. Overall depreciation is the result of all this would be 58, and for the roof this is 50. Let's have our final calculation, which is carrying amount. Cost 20,000. See above. Then we have depreciation. It is also see above. 58 plus 50, 108. And this would be our carrying value or amount. Here I should have a T. And it will come to 19,892,000. Bye.